Good morning, everybody. Hope you're doing well this Wednesday. Morning, Kate.
Good hot morning, Ryan. It's really warm in the southwest of England.
Yeah, lovely. Not a cloud in the sky down here. How about you?
Yeah, it's really nice, really nice.
Yeah, just a good day to be working inside, eh? I'm going to have to get myself a laptop with 8 screens and go into the garden, I think.
Yeah, but I don't have like the sun screens, you know, to the protectors. I wouldn't see.
Yeah.
I wouldn't see anything on my screens.
You need a sombrero, mate. A big sombrero.
Yeah. Oh yeah. Well, I'm in the mix, so that should be all right.
Yeah, you should get a free one. The amount you trade that.
Exactly.
Yeah. Good morning, Hugo. Good morning, Anne. All the way from freezing Melbourne. Your winter over there, obviously, but you make up for it in the summer, no doubt. So you'll be complaining it's too hot in 6 months' time, I suppose. Right, so let's crack on with the show. Just to highlight, I've put a couple of links in the chat there. If you want to check out the ForexAnalytix platform, you want to come and join our great community. Lots of good talk going on in there. If you need help with your trading, just to be part of a good community where you can talk about stuff all day long. It can be a bit of a lonely affair trading at home, and we have plenty of traders, not just for full-time traders. We have part-time traders who can come in and catch up on what's been going on since they've last on. And also the second link there is for the Traders Funding Program. So if you are doing well at your trading and you want to potentially upscale your trading, you can have a look there. I'll just show you the links so you can see them as well. Just there, you can come to the site there and it'll go direct via that link and just see what we have to offer there. It obviously gives you free access to the ForexAnalytix platform depending on what level of assessment you take. We are having some really positive results from that, traders making their way and moving up to a fully funded account. As I mentioned on Monday when we were talking about various things to do with trading, why trade all your money when you can trade someone else's for lower risk. Does need a lot of discipline, that I will say. So you have to be very disciplined with this, but that's the way forward. And yeah, if you want to come and join the ForexAnalytix platform, that link I've posted in there will take you to the Forex Flow site where you can use that to get a 20% discount. Anyway, that's the sales pitching out the way for the morning. My job done, box ticked. Blake will be happy. So let's crack into it. Just a quick question from Anne. Who do I send any questions that I may have regarding the program? CK's answered that. Yeah, there's a chat function. If you follow that link there, you'll find that there's a chat function there you can talk to people about. Alternatively, if you want to just ask us anything direct, go on to the forexflow.live website. There is a contact menu there, contact page there. You can send that to us and that'll come through direct to me and I can look at any questions you have. So look at that, please, Anne, if that's the way you want to go. Right, cracking into the bits and pieces, bit of a quiet one really this morning. Not too much in the news, not too much out on the data front. Just looking back at some of yesterday's data. Canada retail sales came in pretty good, higher than expectations, so looking fairly steady there too. This is April data because Canada's always a few months behind the rest of the world, so it could be that we're just seeing the same as what we've seen in other areas where Q1 data or coming into Q2 has been pretty good, but from May that's when things started to turn for a lot of the numbers. So all good for now, but something to keep an eye on. Now, just another thing that we had, US existing home sales came in softer. That hit a 2-year low. It beat some of the expectations around 5.39, 5.4 million expected, but it did drop from last month. So as I say, that was a 2-year low for this data. Again, following starts and permits, this is the second month on the chart. This number's been weaker, so we are starting to see it. On the flip side to that, we did see prices holding up in that data, and that was one thing I also keep an eye on, because it gives you the median selling prices. And they came in at 407,000, just over 407,000 versus 395,000 in April. So a decent jump there, sort of month on month. Versus May last year, that price was 355,000. So it's gone up a good, $52,500 in a year. So this is the secondary part of looking at the housing data. We're seeing some weakness in the overall numbers, but now it's the pricing that's going to determine whether there's going to be a real issue in the housing market. There is problems with housing supply in the US. There's problems with the supply chains providing the materials to build houses. That's a big factor in why prices are going up, because of those low inventories. If that inventory picture starts to change, if we start seeing more homes coming onto the market, the price is going to drop. That's all well and good. That's fine. That's natural. However, if we still have this tight demand and we start seeing prices drop because rate hikes are impacting people's ability to afford housing, that's when it becomes a different issue. And that's something the Fed will be looking at, because they want to see if and when the US consumer starts really feeling the pinch from rate hikes. So for now, this data showing weakness in the housing market, but the prices are holding up okay. That'll be the secondary bit to look at in the housing data to see if that starts turning south and why it starts to turn south. Going quickly into today's data, the biggest data this morning really was from the UK GDP numbers. Let's get the right page up. Sorry, not GDP, CPI numbers. Now we saw CPI jumping again, 9.1% versus 9% last month. But a lot of people have been eyeing this core number, which came in softer than expected and down 3 pips from last month. Now, what that's done, we've had some headlines coming out that some players in the market have reduced or taken back expectations for the Bank of England. And the headline we got this morning was that they're erasing bets on 3 50 pip hikes by November. There's a bit of a strange one, because we saw exactly the same thing happen in the US CPI, where the headline came in higher, but the core dropped back. That only dropped back 2 pips from 6.2 to 6%. But everyone ignored the fact that the core dropped back and carried on with their bullish Fed expectations. So a bit of selective thinking here about the UK. It's probably half a reason why the pound had a little bit of a drop off. Not a huge amount. These changing expectations are really just tinkering around the edges rather than anything really wholesale. But it just shows a difference between the market can look at one thing and see something, and look at exactly the same situation in another country and see something completely different. For those that are not familiar with the difference between the CPI and the core number usually lags CPI, because that's the feed through from the headline CPI number. The headline CPI number can be more volatile because it does take into effect the moves in energy prices. So you can tend to get big swings there. So look at the core number, maybe as a sort of average, a moving average, if you like. The core number will tell us how much of the headline CPI is filtering through into more domestic prices. If oil prices go up a huge lot, you see petrol pump prices going up quickly. There's a very narrow or thin gap between when you see oil rising and petrol pump prices rising. But for other prices, it takes longer to filter through. When you see a sustained move in the price of oil, then you get firms in logistics starting to put up fuel surcharges, starting to put up their prices, but they don't do this at the same speed that oil moves. So the core number is important because it reflects the more domestic inflation pressures, and that's what the central banks tend to look at. That's where we get the more sustained moves in inflation. That's the type of thing they want to tackle. So the fact that the core dropped back a bit in the UK had the market thinking, oh well, maybe the Bank of England don't have to be as hawkish. Again, it's completely ignoring the fact that at 5.9%, that's still 390 pips above the Bank of England target. Same with the US. The US got a 2% inflation target. Their core's running at 6%. It's still hot stuff. Let's be no doubt about that. But anyway, that's for the UK CPI numbers there. Now, what we have got here in the UK, if you're not aware, if you're not from these shores, we've currently got big strikes in the transport network because the unions want big inflation busting price hikes. We've got a big union over here called the RMT, the Rail Maritime Transport Union, and they're going for 11 to 12% pay hikes for their members, and they're all out on strike this week. But this is starting to grow and become a bit more widespread now. We're hearing about teachers potentially doing the same. We're hearing about postal workers potentially doing the same. Other social services, bidmen, that sort of thing. So this is going to become a real sticky point for the UK because we could see lots of strikes, a lot of hits to services that could in itself create a drop in activity. People stay at home instead of going to work, that sort of thing. But it also can feed into the inflation picture because if these price rises, these wage rises are granted, it's going to be another boost for inflation. And then central banks, not just the BOE, are going to find that they're going to start chasing their tail because as they put rates up, inflation keeps rising. As rates go up, people want more money to cover the rate increases, and it becomes a bit of a infinity doom loop where the people are constantly chasing to get ahead of something they can't get ahead of. It's not just the UK that this is being affected by. There was stories out, and something I've mentioned previously is Germany. They have huge unions and associations over there that look after workers as well. And one of them, IG Metall, they're looking for 7 to 8% wage increases for their members. They've got 4 million members. So this thing isn't small. And there's plenty of other industry heads in Germany who look after wages and do the similar things. So again, this sort of thing could lead to industrial action in countries like Germany. And we're going to get these inflation pressures if wages are put up. And as I say, this is the big point for central banks and why we've got the UK saying now and the Chancellor saying now, they don't want to see wages. We've got to be more restrained about putting wages up because they know that this is going to feed through and it's going to be a never-ending doom cycle of putting up prices, putting up wages. And if they can halt that now, then the central bank putting up rates should impact some of the price pressures. Then the price pressures come down, inflation comes down a bit, and thus you don't need these big wage hikes. Yeah, you can go ahead with wage hikes thereafter, but you can keep them more in line with the fundamentals. Asking for a 12% rate hike just because inflation's at 9.1% is crazy. If inflation drops down to 3-4% over the next year and a half, those people aren't going to want them to turn around and say, right, well, we're taking back some of that 12% wage hike. That sort of thing doesn't happen. So then you're keeping inflation in the market, if you like. But anyway, I'm waffling on a bit. This is something when you're looking at the fundamentals and what you deal with inflation, wages is a big part of it. Why the central banks are focused on wages, why Powell's saying we're going to potentially hit employment because that wages are a part of it. Will bring those down a bit, put a bit of weakness into the jobs market to stop those secondary domestic inflation pressures building up and becoming unmanageable. So that's as far as the news and headlines go. Not much else to come up. Okay, I don't know if you've got any bits and pieces that you heard about overnight.
No, apart from China saying that they will continue to, what was it? Let me just quickly find it back. Continue to support the economy, and I've got the impression that dollar China jumped on the back of it. It's 0.5% higher than where we left it last night. So I think that was the kind of move that we see on the China, and then we had the Bank of Japan minutes out. So Bank of Japan members are talking about yen levels. So I think part of what we've seen today in the yen move, the rejection up in the high 136s, has to do with that. plus the commodity metals risk market is doing less well today than yesterday. So we're back at 136, the figure right now in dollar yen. I think one and all has to do with that for news-wise or headline-wise anyway. But for the rest, I haven't seen anything specific, no.
Yeah, and I think that's a key feature. You know, we came into Monday and saw a bit through Tuesday, sort of some of these risk-on moves, if you like. And to me, it looked a bit false. You know, I did understand why suddenly the world was a much cheerier place. Nothing's really changed. And I thought it might have been a bit of leg stretching, just having a wander around. And today we seemingly going the other way. You know, the dollar was stronger this morning. That's flipped around a bit. Dollar yen. Yeah, you know, we had the break up yesterday. I took a break long. I had a buy stop in at 135.65, just because I kept feeling that we were testing this area, this resistance, and the dips were getting more and more shallow. And I had one of those gut feelings that if this didn't break hard, I'd eat my hat. So I went with a buy stop. I knocked some out up along the way. I got my highest out is 136.65. I think it was 65, 63 is up there. Right up near what's become a top that I've marked now. So, and just as we see sitting here, we're breaking 136, which was the support that developed after we got above there. So this break level here around about 135.60s is going to be the key level for this particular phase, this particular move. If it breaks back under there, then we're potentially going back in a box, and we'll see the range then where it wants to decide where it wants to go. Certainly down towards 135, 134.5. If we get down there, then potentially, as always, I'm looking for what the price action is developing, what range is developing, where the support's going to come in, where the resistance is going to come in, because we see this type of action time and time again. You know, we see levels become resistance, then we have a little break. Then it comes back down again, and then we test the lows, then we have a little break. You know, this is pretty much setting up for the same thing. So each time the market sets its levels, it's setting 136.70 as its resistance level. If you want to do something, we've got to get above there. What's going to happen with the support from here now? 136 has failed, 135.60 is the next area, then we get down into the low 135s. So for me, I've not got a strong view over this. On one hand, I want to be cautious with longs because of the Bank of Japan or intervention, the Ministry of Finance intervention risk. And, you know, the higher it goes, the greater the chance that they start ramping up their jaw boning and heading towards action. But on the other side, I don't mind being long because, you know, the trend is your friend, and it continues to break higher. Albeit doing it a bit more slowly now. So I'm happy to go with longs, but I'm keeping longs on a much tighter leash than I would if I was in shorts, purely based on the intervention risk there. I know Kay and a few of the others took this one in the room. What's your view overall on this one?
Yeah, I think we have to look. I was long over the whole day yesterday, as I've said. I bought in the low 135s to start the day, because I also thought, and I was looking at the yields and what the Bank of Japan was doing the day yesterday. So I went short low 135s around the weight, and then leg gradually out into the 136s, and I've just been done on there was only a quarter left of what I had, so I've just been done on a trading stop because I wanted to guarantee my profits on the one side, and on the other side, looking at what is happening in the risk market. I didn't want to go like stay blindly long dollar yen or long yen crosses, and then possibly get a little bit hurt on them. So I'm quite happy to be out of it for now. But I'll be looking anyway based on the major thing, which is the central bank divergence. I'll try to get short yen at some stage in some form again, but I'm not yet sure. I might let this one go a little bit and see what happens around 135.50, 60 if ever we get there, and then see what happens. So I also think that a lot of what we are seeing now is a yo-yo linked to what the rest of the instruments are doing. We can't forget that a part of the yen weakness was due to much higher energy, much higher commodities, because Japan is a big importer of that stuff. So if oil and if commodities come off, there is a certain logic that the yen would not continue to weaken straight away, even might recoup some of its losses. People who are short yen take profits. You know, I mean, we could have the same situation building as the ones we've seen. First hit to 125 and above, came back down very hard to 121, and then we went up to the 131, and then we had this 131, 126, 127 yo-yo for a while. So now we're going to another high. So we had a 135 and then back down to 132s. And now we've done a fresh high. It's not impossible that we are going back to see 133, 134. I think 134, 40, 60 is now the most important level for really holding the continuation, a normal continuation with like new highs, setback, and then a new high. I think the 134, 40, 60 is going to be the one that I'm really monitoring right now on the dollar yen side. And then look, market to give you directions on whatever happening in commodities, risk, and things like that.
Yeah, I agree with that 100%. And I was going to look at the, you know, we've talked about, you know, what could be driving these sort of moves. You know, yields is one effect, but we haven't really been following yields. But here we are seeing a move lower in yields, and it's not a surprise to see dollar yen lower. As Kay mentioned, you know, a big part of it, the picture for yen is oil, and here we are seeing a move lower in oil. You know, down some, you know, 12, 15 odd bucks in the space of a few days. That is going to have a big impact on things. I'm not entirely sure what the move in oil is all about. There's obviously, we keep switching between you know, global growth issues due to higher rates, slowdowns, recessions is always the talk. That's one factor, but it looks a bit sharp. Now I know we're getting this Biden announcement supposedly today for a temporary suspension of the gasoline tax. I'm not sure why, if that's a driver, and why it would be negative for oil. Maybe I'm just not getting the picture there. But he's supposedly going to announce that sometime today. But a lot of people will look at this and think, okay, well, that's, if oil's, you know, dumping off, that's going to take some of the inflation pressure away. And this discussion we had in our room today, actually, you know, there is a lag between what you see in oil moves and when that filters through into inflation. You know, inflation is still pricing in, if you like, what happened at the beginning of the year. You know, I mean, this sort of thing can take, you know, 3 to 6 months to filter through to prices. It's a bit quicker in headline inflation, but as we're talking about the core numbers, it takes a bit longer. So the fact that we've had a fairly decent move down in June doesn't necessarily mean the Fed are going to cut their hike expectations or their hike path down to 25 pip hikes or 50 pip hikes just because oil's come off. They'll note it, but look at where we've been since the start of the year. You know, we're still up sort of 40 odd bucks since the start of the year. So all this is still coming through and filtering through into different ways into the inflation picture. So just because we see this move, it doesn't mean, oh, suddenly inflation's going to fall off a cliff next month. Doesn't work that way. But as I say, I don't know what the driver is for here, for this big move in oil is. As I say, it can be linked to expectations of recession coming, but I'm not too sure. But for dollar yen, going back to the currency, you know, this move does look a bit oil, but it also looks like a bit of yield weakness yet again, as we can see here and just showed. Let's get up. It just can't, you know, yield just can't maintain these highs, and that, as we said yesterday, is a reflection of what the market thinks rates are going to get to. Is the market now thinking, well, perhaps rates might not get as high as 3.5%, 4% as the Fed are expecting? These sort of little changes day to day is what drives markets. But for the moment, I'm not seeing a lot of big trend changes anywhere. So I still feel that in the short term, and this may sound repetitive, you know, looking at something like euro dollar, we're just mooching around the levels. We're not going anywhere. We're in this range, and this is just a bit of wandering around. Now, for me, that can become pretty boring, sitting here watching the same old thing day in, day out. But that's where I've just got to exercise my caution and wait to see if we get a move to either edge. You know, I have my levels. I pick my levels. I pick my points. Those are the ones I'm going to trade. Yeah, don't get me wrong. If there's a headline that pops up that I can snipe, I'll do so. But otherwise, I just sit here and wait for the levels and judge the moves at the time. You know, so we've had another move under 105. So this is becoming a bit flip-floppy around 105. It's still, for me, a bit of a pivotal level. You know, when it gets below and holds below, then we tend to get a move down. But now we're seeing it up and down, up and down. We've gone back above, you know, just starting to find it as support again. We've had another push up higher. You know, what's he got to do? You know, 105.40s. That's the short-term number to break. It's all these little steps moving around there. If you're a scalper, this is probably gold for you. You know, I'm not that way inclined. I've never been a good scalper, particularly in FX. So I tend to set my sights a little bit wider. It's a bit more relaxing. Kay, you got anything on euro dollar? Anything specific you're feeling about this one?
I am still thinking that the euro has a lot of weight around its neck. I'd rather open the short side first. But yeah, it's a real yo-yo for the time being. I was talking about it in the room this morning. Everything we see now is a bit of a double-edged sword. Whether it be on risk or on yields, or so I'm in a yo-yo mode. I don't mind selling, but I like to open the short side on the euro first, because I think there's still a lot weighing on it. Yeah, and if you look at today as well, and also a reason why I'm in yo-yo mode is to look at those yields. Yields are absolutely going together all around the globe. If you look at the dollar yields have come off again from yesterday, but then at the same time, the German yields are coming off exactly the same thing. So you have the algo correlation. The algo is firmly plugged into risk markets or oil or gold or commodities, and but we are going in places fast, but never keep the levels. So that's why I'm still in yo-yo mode right here and now. And also, when I say opening short euros, I select my currencies against which I'm doing it. Perhaps euro dollar is not the best vehicle, but if you look, for instance, at euro Swiss, which had a big drop after S&P, it's capped in the 102 figure a half zone, and then it's getting bit under 101.5, and I'm of course short. I'm happily keeping it short unless until 102 40 50 would give way for as long as it caps. And in the meantime, I'm not refraining of buying back 101.60, and between 101.60 and 30, there seems to be some bids around 101.35 in euro Swiss. Another euro pair that I've been trading from the short side is euro CAD. I covered it this morning because I saw oil getting dumped. It's in a range 136, 137 right here and now, but I still like to keep trading this from the short side first, for as long as oil is keeping, let's say, the 105 line. If we drop below 100 in oil, I think then those euro and yen pairs could do some funny moves if that would to happen. And then, but I'll take the charts a little bit later on the emerging markets and gold and silver.
Yeah, I guess what I'm saying is, you know, depending on how you trade it, it can be frustrating. You know, 1 minute market's up, 1 minute it's down. There's no, you know, rhyme or reason to it. and it can be frustrating to traders because you get in a position, you get a bit on side, you don't lock it in, you don't bring your stops up or anything like that, and then suddenly it goes against you, and you can find that you're losing little amounts but losing them often, because the market is a bit frustrating, and that's why I tend to just pick my levels. I'll be happy to trade, maybe go a bit wider, look at these ranges, like Kay's saying here, he's been selling up here, happily buying down there, looking for potential break trade in this one. You can apply this, doesn't matter what currency you're trading, what market you're trading, you can apply this theory to any market you want. You pick your levels, you say that's where I'm going to trade, that's where I'm going to trade. In between here, I'm not interested. And if you don't do anything, you don't do anything. What I won't do is chase a trade because I'm getting bored. If I find I'm doing that, there's trouble brewing, because I don't like trading for the sake of trading just because I'm bored. It is a tough psychological feeling to get into, because you don't want to waste your time when you're watching these markets, but there's times you just have to exercise a lot of patience in these sort of things. Right, just have another look around. Kay, do you want to take them and do your quick rundown?
Yep.
Let me, where am I going? Let me get out of here. All yours, mate.
Alrighty. Here we go. Yeah, first of all, a quick look and a quick overview of what I was saying in those yields. If you look at, these are the short end ones, the 2s and the 3s in US and Germany, and look, it's a nearly perfect overlay, right? So the European and US yields are moving in tandem, and that's why we see this euro dollar having trouble to break out of ranges based on the yields. So again, I will repeat data, and that's what we've been saying on Face as well. I think data will going forward will be drivers again, because they are going to drive what the central banks want to do, apart from stuff like yen, which is a little bit of an odd one out, of course, because we have Bank of Japan. And then what we were talking about yesterday, it's a small move, but we kind of held the support here in the Italian and German spread. You move it higher. It might have been part of the euro dollar as well, but I wouldn't overdo this one. If it stabilizes around here, call it between 198, 195 and 210. I don't think the market is going to pay too much attention to it going forward. But then look at like, for instance, UK yields, they've come off as well today. Look at Australia, Kiwis hanging higher. But look at Australian yields also coming off today. So everything is moving relatively in tandem, and that's why we are seeing those ranges in the FX in the major FX pairs right now. So that's why I'm saying the crosses may be a bit more interesting. So first, a quick look on gold. It is trying to break. And now we're back onto this 1828. I don't really know what to do with it. Give me an 0711 level. I may try a little long with a stop below 8800. Perhaps it all depends on what's the driver of the next move. I don't have anything in there, and I'm very happy to stay out for now. I think it's really in a range and doing the yo-yo like the rest of what we are seeing right now. Silver, idem dito. We're still in this 21, 2089, 89 up to 22 figure 15 zone. I'm not touching it. I keep my long-term small long, and then see if I perhaps can catch another knife if it comes sub 21, but all depends on the reasons why. And then I would like to move over to here, those things. So first of all, dollar mix, as we look at it regularly, it's heavy. I think it could get down to 20 the figure ahead of the Bank of Mexico, which we have tomorrow. We are Wednesday today. Tomorrow we'll have Banxico, and they are expected to hike 75 BPs. I think being a high yielder, this makes unless risk really drops away, this makes has the potential to stay firm. I haven't got anything in the dollar mix, but I'm back short euro mix on this break here yesterday. I added. I was like having an OCO in there. One cancels. Well, no, actually two orders in there. I had a break order here and an order to sell closer to 21.40-42 in the euro mix, because for the same reasons there's a big interest rate differential between euro and the mix, and when the market is in doubt, they might still trade a bit of carry and then continue to keep the mix on a firmer note for as long as the data don't tell us otherwise. The rand is a little less obvious. We need to get back and stay sorry, below 1587, which we tested again yesterday. But we can't, and we are starting to form a bit of a solid bottom down there. Top side close by 1608.10, but then the big level is still in those 1630s for me. For the time being, I'm leaving this one alone. And then lastly, Norwegian kroner has really traded oil lately, because we saw when oil went back up, we saw the euro and dollar Norway come off. Then as we hit the tops, it was flying. Then we hit this had this recovery again, and then yesterday we saw euro NOK and dollar NOK come off pretty sharply, but then the dollar NOK held well roughly around the 980 zone. Went a little bit below, but couldn't crack this one. And this morning we wake up and dollar Norway is like 1% higher again. So this one is really going to play the yo-yo. We have Norges Bank tomorrow. Market is expecting 25. I'm not excluding a 50 BPs one in there, because they also had high. They have the high also. The companies are buying quite a bit of Norway to pay taxes. Norwegian kroner is nowhere too strong, so I would not rule out a 50 BPs from the Norges Bank tomorrow. And that's about it for my little look this morning, Ryan.
Yeah, no worries. Just going to take when you've finished your sharing, I'm just going to take it back again.
Okay.
Just a couple of comments there from the viewers. Both Mike and Gavin's there, talking about the yo-yo and the trend is no trend. Well, yes, and this is the funny thing with FX markets. There's so many contradictions. There's the euro dollar chart, an hourly chart, just showing the last couple of weeks. What does that tell you? That tell you, yes, we're in a bit of consolidation going sideways. There is no trend. Okay, there's no trend for the short term. But meanwhile, what's the longer trend? The longer trend is still in a downtrend. And this is why it's important you go through your time frames. You start from things like this, from the wider time frames, the weeklies, the monthlies, the dailies, just so you've got an idea, where is the trend. The trend short term is sideways. The trend longer term over the last year or so is down, and there's no indications that the trend is changing. We can't get above things like the 38.2 fib of just this year's move, let alone the move from last year. So this is why you look over your charts, because this is the key level for the longer term trends. This is what I look at. I look at this 38.2 fib. It's held. It's a solid level. If this trend is going to change, that's the sort of level it needs to break. Same on the downside, down into this 103.40, a huge level, going back to 2017. It stands for itself. It speaks for itself there. We expected something to happen down there, and it has twice. So that's where your big levels are. If you get above here, it indicates perhaps that the trend is changing, at least for this shorter term move. the 38.2 of the move last year isn't until 110, nearly 111. So again, that doesn't tell you the trend is changing. So then what you can do is you can come down and look at these levels in more detail, find the ranges in between here that are developing, and those are the ones you trade. But keep an eye on the bigger picture. Always keep an eye on the bigger picture, because if this trend isn't broken, then at some point we're going to see 103.40 broken, and the trend is going to continue. And as I said, conversely, if this trend is to stop, if this downtrend of a year or so is going to stop, it needs to start hitting some of these above some of these higher levels. And that's what we factor in. That's why I look at these levels, because yeah, we can mess around in the middle, trading the intraday ranges day to day, in between these sort of areas. Great, but what if they start breaking? What do you do if this starts breaking? This is where your potential big money is going to come from, because a potential break up here then can see you up to 110, 200-300 pips higher. And those are the ones you want to set up. Yeah, I'm happy to short there, but if we come up and test it, I'm going to have a little buy stop above, potentially, and look to see where we go up. Same for the downside. You know, trust the level down into 103.40, but it'll be potentially the third time we test it. If we go back down there again, it's got a potential for a break trade lower. So it's all about matching up your longer time frames with the short-term noise, because a lot of people get sucked into this. Oh, euro's doing nothing, it's going sideways, it's not doing anything. Then wallop, you think, oh yeah, this is a little break, it's nothing special. Bang, next thing you're trading at 101. Top side, you're then trading at 110, and it happens in a flash, and you've missed it because you got too sucked into the short-term picture. So it's always good, you know, have your binoculars out, have a look around. Gavin, looking at euro sterling. Yeah, it's up and down. It's up and down again. I'm a bit fearful this is gonna really tread water for a bit, and when it does so, it can do it quite tightly. You know, if we're stuck in 100 pip range, that's going to be a bit of a bore fest. And we've seen done often. You get these big periods, or you get these little periods where you have a big moves, and then you get these longer periods where it's just sitting in tight ranges for weeks on end. I'm fearing the same thing for this. At the moment, this isn't moving because of any real changes to central banks, or the bigger picture regarding central banks. This is moving around a bit more due to the volatility difference between euro dollar and cable. Cable is far more volatile, and that is reflected more in euro sterling. So when I'm looking at euro sterling, I want to see, I'm long, obviously, as you guys and girls know. I want to see this pair moving, or euro sterling moving, because of some fundamental reason, the ECB being more hawkish, or the data getting worse in the UK or getting better in the eurozone. That's what I want to see as a driver, not this higgledy-piggledy mess because cables jumped around 100 pips in a few hours. It just doesn't conform to me. But as I said, if you're a more shorter-term trader, a bit of a scalper, you look at these levels, intraday 85, 60, 70, and then if we get up here, it's a bit more messy on the top side, 86, 11, 10. We've had a little break, then it's held right after. If you want to ping pong your in between there, be my guest and many pips due. On the other hand, we'll wait for these bigger edges. Once again, taking into consideration the bigger picture, what it all means. We had this test up to the 50 fib. A break above there would have potentially changed the trend, in my opinion, but we couldn't. The level held, and down we come again back into the box. What do we do next? Do we go back lower, or do we have another look higher? Who knows? But you pick your levels, as I say, stick them on your charts, and you trade as you see fit. Now, one other thing we have got coming up today from the US is Fed's Powell with his semi-annual testimony on the monetary policy report. Now, for you boys and girls who are in the on the ForexAnalytix platform, I put the monetary policy report out in the news and research room. That was out on Friday I completely missed that amongst all the other stuff coming out. His testimony will be released as text. Usually it comes out about an hour before his actual appearance, hour and a bit before his appearance. He's scheduled at 14:30 UK time, which is 13:30 GMT. So expect the text to come out about an hour before, and that's usually his statement, what he expects the market to do. It's based on this monetary policy report, but he puts his own little bit of flavor on it, his own bit of fluff. So that sometimes there is a risk there that we get something in that we haven't heard from last week's FOMC, and then he faces 2.5 hours of grilling by the politicians. Again, there's some small risk there that he gives us something we don't know. I think it's pretty low risk. They've been pretty explicit, the Fed at the FOMC, but it's still a risk that we have to keep an eye on. Now, unless there's anything else you wonderful people want us to look at, we'll call that a bit of a session. By the way, the power thing is 2 days, so he goes in front of two houses, one today, one tomorrow. Tomorrow's usually just a repeat of what happens today, maybe with different questions, but the same statement will be issued, the same report will be issued. On the data front, just quickly, we've got the NBA out. Again, going to see, looking at that for further signs that we've been seeing in the market. As I mentioned, it's a weekly number. It has been pointing south. We had a little bit of a bounce last week. Let's see if that's dead cat this week. And Canada inflation numbers. We get to see if they're going to be hot as well. Is this going to play into the Bank of Canada's path of interest rates? Is it going to be higher? Is it going to be lower? We'll get to see, again, the market probably trading more around these sort of data. So if you're looking at the loonie, keep your eye on it for this data. Still sitting in this zone, 129, 131. Play the edges, look for the breaks. Anyway, thank you very much for your continued support of the Flow Show and coming and watching us. I hope it's useful for you guys. Enjoy your day. Stay safe. Thank you very much, K-Man, and we shall see you tomorrow.
Have a great day, everybody.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.